The Chairperson of Finance Bill and National Planning Committee of the National Assembly tabled the Finance Bill 2024 on 13th May 2024. The bill proposes various changes to the Income Tax Act, the VAT Act 2013, Excise Duty Act, Tax Procedures Act 2015, and the Miscellaneous Fees and Levies Act, among other non-tax statuses. All the proposed changes will be effective 1st July 2024 unless stated otherwise. These measures are expected to impact differently on businesses, sectors, as well as individuals. These thus affected businesses, sectors, and individuals should consult with their tax advisors on how these measures impact them. The following are key highlights. Taxation on motor vehicles. Motor vehicles tax, a new tax at the rate of 2.5% of the value of the motor vehicle has been introduced. The value is determined by the make, model, engine capacity, and the year of manufacture. There is a minimum tax amount of Kenya shillings 5,000 and a maximum of Kenya shillings 100,000. Per diems and employment benefits. Tax-free per diems. The bill proposes an increase in tax-free per diems to an amount not exceeding 5% of the employee's monthly gross income. This change aims to standardize the per diems policy across various sectors. Retirement contributions. Increased pension contribution deductions. The tax deductible limit for contributions to registered retirement schemes has been increased from Kenya shillings 20,000 to Kenya shillings 30,000 per month. This is intended to encourage more savings towards retirement. Digital services taxation. Significant economic presence tax. The existing digital services tax is repealed and replaced with a significant economic presence tax. This tax is assessed at 30% on the deemed taxable profit for non-resident entities deriving income from digital marketplaces in Kenya. The deemed taxable profit is calculated at 20% of the gross turnover earned. Digital content monetization. Both resident and non-resident persons engaged in digital content monetization will be taxed. Non-residents will face a 20% tax rate on their income, while residents will be taxed at 5%. VAT changes. Increased VAT registration threshold. The threshold is mandatory VAT registration is raised from Kenya shillings 5 million to Kenya shillings 8 million, reducing the burden on smaller businesses. Removal of VAT exemptions on financial services. Several financial services previously exempt from VAT will now be subjected to VAT at 16%. This includes the issuing of credit and debit cards, telegraphic money transfer services, foreign exchange transactions, check handling, and issuance of securities for money. Exemptions for transfer of business. The transfer of businesses as a going concern will now be exempt from VAT, simplifying the process for business sales and acquisitions. Tourism and manufacturing sectors. Certain VAT exemption in the tourist and manufacturing sectors has been scrapped. These include exemptions for goods and services used in the construction of tourism facilities and investments in manufacturing. Income tax adjustments. Infrastructure bonds. Interest income earned by residents individual from infrastructure bond will be subject to 5% withholding tax. This is aimed at increasing government revenue from bond investments. Family trust. Income from registered family trust will now be taxed at a rate of 30%. This move aims to curb the use of family trusts for tax avoidance. Excise duties. Telecom and financial services. Excise duty on money transfer services remains at 15%, and for betting and gaming, it remains at 12.5%. Additionally, a 20% excise duty will be applied to fees charged by digital lenders and banks, potentially increasing the cost of these services. Environmental levy. Eco levy. An environmental levy will be introduced to ensure that the manufacturers and importers pay for the negative environmental impacts of their products. This includes specific electronics and goods like tires and diapers, and a 10% tax on imported phones. Enhancements to KRA powers. ITIMS registration. The bill mandates that taxpayers integrate electronic tax invoice management system, ITIMS, in their invoicing processes, with penalties for non-compliance. This is aimed at improving tax compliance among businesses. Data protection exemptions. The bill grants the Kenya Revenue Authority, KRA, exemptions from certain data protection laws, allowing it to disclose information for tax assessment and collection purposes. This has raised privacy concerns, especially in sensitive sectors like healthcare. New tax measures. Minimum top-up tax. A minimum top-up tax is introduced for multinational entities where the combined effective tax rate is less than 15%. This tax is aimed at ensuring that multinationals pay a minimum level of tax in Kenya. Implications and controversies. These measures are part of the government's effort to increase revenue and improve tax administration. However, they are expected to face significant opposition due to their impact on businesses and consumers, including increased costs of goods and services, compliance burdens, and privacy concerns. The bill's proposals are seen as a mix of necessary revenue measures and controversial changes that may affect the economic landscape in Kenya.